to your Monday Futures Market Outlook for February 14th, 2011. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eMiniSource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. In the summer of 2010, when we hit the low points holding in around the 1,000 level, we were looking for the market to finish a measured move higher, which was targeting zones around this 1300 to 1350, even as high as 1380 on the upside. And while we certainly cannot rule out that there could be some further short-term upside and even markets that stabilize even into the second quarter of the year, we are certainly reaching some of the upside targets. So we do believe that there's a marginal upside, even though we're not necessarily outright bearish yet. When we take a closer look at the S&P 500 using the daily charts on the E-mini futures, we were looking for an upside move ever since that failed breakdown, and our upside targets in this area work around this 1325 to even as high as the 1360 level, where there's a number of different measured move targets on the upside. Again, like we were emphasizing, even though there's certainly nothing stopping the market from actually digging in and even holding these levels for even another week or two and even pushing to higher highs, overall the risk-reward proposition of remaining long this market versus the potential risk of a profit-taking cycle is marginal at best. So certainly if anyone that's remaining long this market, it's certainly prudent to be taking profits into strength. Just to review our key points, we have an intermediate bullish bias on this market that we've had on there for the last 6 months. But at this stage, we're at a juncture within the market where we're only a few percent from our upside targets of the year. And at some stage, a profit-taking cycle should emerge from these levels. So anyone that remains fully invested long is essentially trying to gain a few percent on the upside at the risk of 5 to 10% on the downside. That proposition usually is not a good one, and therefore taking profits into strength is a prudent thing. There continues to be momentum loss and a lack of market breadth. We continue to see more and more stocks dropping below their 50-period moving averages, while there's a few large cap stocks that maintain this market at these higher levels. The bulls successfully fended off early attempts by the bears to start that profit-taking cycle, but overall those higher zones are being approached in this 1330, 1340 area on the upside. Next here, I want to take a look at the NASDAQ 100, and we drew on upside targets also in this area as I approach the 2400 to 2450 area. Some shortened moves even target this 2380 area. So again, we're at a situation where we're not bearish on the market yet, but the upside potential is marginal. Next year, we'll take a look at the U.S. dollar index futures, and the U.S. dollar index is actually at a critical level because this could send shockwaves through all the markets as we go through here. This right now has been rallying up, and we certainly in this blue boxed retracement zone cannot rule out the possibility that this is simply a retracing flag. Now we'll have the U.S. dollar index at some point resume a bearish trend to test even the 75, 50, 76 area on the downside where all those previous lows occurred back in November. But if for whatever reason we have anything that starts strengthening significantly through the 79, 79.50 area and starts getting above that retracement zone, we could see a U.S. dollar short squeeze on the upside, which could have a very dramatic fast rally higher. That would certainly send shockwaves through the commodity market. So we are at a make it or break it moment for that dollar index futures, and we're going to want to see this week how this plays out in the zone. If that dollar index rolls lower and we start seeing 78 on the downside again, then we certainly know that we're out of the woods for a little while and can continue to see some strength in copper and a couple other commodities. But again, if the U.S. dollar starts to short squeeze on the upside, that would certainly send a number of commodities spiraling. Next year, I want to take a look at copper futures. We're going to start analyzing copper futures within our Monday market profile and going forward. I wanted to highlight this flagging formation here at marked off by those two blue lines that is targeting copper to even a push up to even as high as 480 to 500 on the upside. But again, this certainly would be stifled by a U.S. dollar short squeeze. Really, in order for copper to hit that upside target, we would need to see the U.S. dollar weakening during that cycle. And so where copper's heading here off this particular level right here will have a lot to do with a direct play on the dollar. Next here, I want to take a look at gold futures on the daily charts there, and gold has been flagging higher, and we marked off this zone around this 1360 to 1390 area, which marks the retracement zones of this flag. And essentially, if we have gold fail in this area right in here and roll over, then gold could have another move lower that hits targets all the way down into 1240 to 1300 on the downside. We'll be watching how this develops here. It would take a legitimate rally through this 1380, 1390 area on the upside for the gold bulls to regain momentum and at minimum come back for a retest of the previous highs, if not open the window for a substantial rallying in gold. But I would not be even considering that until we see the gold bulls have enough momentum to beat this blue box. If they don't, then we still want to be bearish gold for one more leg lower. Next year, I want to take a look at crude oil futures, and this is using the mini QM contract. Again, we had a crude oil reject off of the previous highs as we talked about last week, and again find ourselves now testing the 85 to 86 support line underneath. Really, at this juncture, we're now seeing breaks of the key trend lines on the upside, and we're at a make it or break it moment. If we see that dollar index, U.S. dollar index, start short squeezing higher, crude will break this low, and if it does, we'll see $78 to $80 on the downside. I haven't drawn that in here, but that would be a very realistic downside target here. But we want to see that kind of come in line with a U.S. dollar index breakout on the upside. Finally, I want to take a look at the 10-year Treasury notes, and we continue to see relatively bearish consolidation at lower lows on the 10-year Treasury notes. If this little 5-day candle pattern here is just a short-term flag, we should see a breakdown in these Treasury bonds below the 118 handle and head right down to 115 to 117. This here is our downside measured move. Now, in the bigger picture, if 10-year Treasury notes start bottoming out here over the next 3-4 months, a lot of these moves on the downside may actually be much shorter, as there'll be a big support and accumulation occurring along these bottom end of these markets. If we have a strong U.S. dollar breakout on the upside and commodity weakness, then at least it would stifle the short-term pressure on the idea that inflation's coming into the system, and that would certainly allow bonds to start stabilizing down at these lower levels. That was your Monday Futures Market Outlook. Thank you for joining me.